Hi. Let's learn about impact investing. Impact investing is an investment strategy that aims to generate specific beneficial social or environmental effects in addition to financial gains. Impact investments may take the form of numerous asset classes and may result in many specific outcomes. The point of impact investing is to use money and investment capital for positive social results. The term impact investing was first coined in 2007, but the practice was developed years earlier. A basic goal of impact investing is to help reduce the negative effects of business activity on the social environment. That's why impact investing may sometimes be considered an extension of philanthropy. Impact investments come in many different forms of capital and investment vehicles. Like any other type of investment class, impact investments provide investors with a range of possibilities when it comes to returns. But the most important thing is that these investments offer both a financial return and are in line with the investor's conscience. The opportunity for impact investments varies, and investors may choose to put their money into emerging markets or developed economies. Impact investments span several industries including environmental, social, and governance, ESG, and socially responsible investing, SRI. Socially and environmentally responsible practices tend to attract impact investors, meaning companies can benefit financially from committing to socially responsible practices. Impact investing appeals largely to younger generations, such as millennials, who want to give back to society, so this trend is likely to expand as these investors gain more influence in the market. A 2020 survey found that more than 88% of impact investors reported that their investments were meeting or surpassing their financial expectations. SRA, which is sometimes referred to as sustainable or socially conscious investing or, when focused on environmental causes, green investing, is a form of impact investing. While the definition of SRI encompasses the avoidance of harm, impact investing also suggests positive impact via its investments. Investors who practice SRI tend to believe in and choose companies that subscribe to their views concerning human rights, environmental protection, and a sense of responsibility to consumers. One of the most well-known impact investment funds is the Bill and Melinda Gates Foundation, launched by the celebrated Windows pioneer with a total endowment of nearly $50 billion. While most of the Gates Foundation is engaged in philanthropy, it also has a strategic investment fund with $2.5 billion under management, which is invested in ventures that align with the foundation's goals of improving health, education, and gender equality. The Soros Economic Development Fund is part of the Open Society Foundations, launched by billionaire philanthropist George Soros. Soros has contributed about $18 billion to the Open Society Foundations, $90 million of which is actively invested in impact ventures. The foundation seeks to support open societies by promoting democracy, legal reforms, higher education, and journalism, among other fields. The Ford Foundation was launched in 1936 by Edsel and Henry Ford, with an initial endowment of $25,000. Today, it has one of the world's largest private endowments, with $16 billion under management. Most of that money is given as grants to support causes aligned with the values of the foundation. However, in 2017 the Ford Foundation announced plans to invest $1 billion in business ventures aligned with their mission. Impact-focused investing, or simply impact investing, is an investment strategy that seeks to achieve social or environmental goals, as well as generate profit. Unlike philanthropic endeavors, impact investors typically expect a return on their investment, although this may be a secondary consideration. Most impact investors seek returns that are comparable to market rates, and some impact funds can even outperform the market. Generally speaking, the returns from impact investing tend to be slightly lower than the market average. In a study by the University of California, the median impact fund had a median internal rate of return of 6.4%, compared to 7.4% from non-impact seeking funds. Environmental, social, and governance practices refer to business decisions that could affect the returns of that company. For example, a company that knowingly employs child labor or engages in discrimination could be at a competitive disadvantage, particularly when marketing to socially conscious consumers. Impact investing, on the other hand, is the practice of seeking investments that specifically optimize a goal other than profits. This might include investments in clean energy, education, or microfinance. An impact investing firm is an investment fund that specifically seeks to support beneficial social or environmental outcomes, in addition to generating financial returns. Some impact funds invest in causes that they believe will generate strong returns, others consider profits to be a secondary consideration. An impact investing strategy is an investment strategy that targets companies or industries that produce social or environmental benefits. For example, some impact investors seek to support renewable energy, electric cars, microfinance, sustainable agriculture, or other causes which they believe to be worthwhile. Here are 5 key takeaways. 1. Impact investing is a general investment strategy that seeks to generate financial returns while also creating a positive social or environmental impact. 2. Investors who follow impact investing consider a company's commitment to corporate social responsibility or the duty to positively serve society as a whole. 3. Socially responsible, SRA, and environmental, social, and governance, ESG, investing are 2 approaches to impact investing, although there is still some disagreement over terminology in the investing community. 4. According to the Global Impact Investing Network, more than 88% of impact investors reported that their investments met or exceeded their expectations. 5. Studies show that the median impact fund realized a 6.4% return, compared to 7.4% from non-impact funds. Hope this would help. Thanks for watching.